Okay, let's unpack this.
Let's do it.
Today, we are diving deep into Sumitomo Chemical India Ltd, SCIL, big player in the Indian agrochem space.
That's right. And we're looking specifically at their recent performance strategy update, really, based on their Q2 and H1 results for fiscal 26, ending September 30th, 2025.
And the source material itself, their investor docs, they've framed it under this banner, A Year of Resurgence, SCI 2.0. Quite optimistic.
It is. And that's our job today, isn't it? To figure out if that optimism is justified.
Exactly, because, the agro input business, it's seasonal. Q2 was clearly rough going, thanks to the monsoon.
Right.
So we need to cut through that noise, look at the data, and see if this resurgence is real. Are they building underlying growth? De-risking? Do the investment plans make sense?
Or is it just good marketing? Let's find out.
Yeah.
So section 1, let's tackle that Q2 headwind first. The monsoon impact and the financial dip.
Yeah, when you look at SCIL, or really any Indian agrochem company, they always say look at the full year.
Always. Seasonality is huge.
So why was Q2, July to September 2025, particularly tough?
It was the monsoon, but maybe not how you'd expect. The source material says there were persistent, widespread rains from mid-July right through September.
Okay, so too much rain at the wrong time?
Exactly. It just disrupted everything. Farmers couldn't get into fields, missed their spray schedules. The usual agronomic activities were just, well, stalled.
Right.
And here's the slightly counterintuitive part. All that wet weather actually led to less pest incidents overall, even though there was localized crop damage. Think cotton, soybean, rice.
So less pest pressure means fewer chemicals bought and used.
Precisely. And you really see that reflected in the Q2 numbers year on year.
Yeah, lay those out for us.
Okay, so consolidated revenue from operations, it was down 6%, came in at Rs 929.8 CRs, and that's crores, tens of millions for listeners.
So down 6%. Ouch.
And the profitability took a bigger hit. Operating EBITDA, that core profit measure, down 11% to Rs 218 crores.
Okay.
And the bottom line, net profit after tax, PT, that fell 8% to Rs 177.8 crores.
So double-digit drops in core profit. How much is just volume lost to weather versus, say, pricing pressure or inventory issues creeping in?
That's always the question.
Yeah.
The company mostly points to lower volumes from the monsoon disruption. But it's worth noting exports were soft, too.
Oh, were.
They mentioned lower demand, shipment deferrals, specifically in Africa and Latin America, although the U.S. and Europe apparently held steady. So a mixed bag on exports.
Right. But here's a point that really stood out to me, kind of supporting their strong internal control narrative.
What's that?
Despite the tough quarter, the sales pressure, they explicitly state they maintain business continuity without material sales returns or collection delays.
Yes, that's crucial. That's the operational resilience piece. They even contrast it, saying the broader industry was seeing inventory buildup and payment stress.
So it suggests their channel management, their credit discipline, was maybe holding up much better than competitors, even if the top line took a weather hit.
Exactly. They didn't get stuck with bad inventory or uncollectible receivables. Big difference.
Okay, so that's the tough Q2. Now, how does that square with this whole year of resurgence theme? Seems contradictory.
Well, this is where shifting perspective is key. You zoom out from the difficult quarter and look at the cumulative first half H1 FY26.
Right. The idea being if Q2 was just a weather blip, H1 should still show the underlying strength from Q1.
And, well, it does. The numbers paint a very different picture for the first 6 months.
Okay, let's hear them.
Consolidated revenue for H1 actually increased 9% year over year, reached Rs 1,986.6 crores.
Okay, a 9% rise for the half year. That's solid.
And net profit, POT, was up even more, 11%, hitting Rs 355.9 crores for H1.
So that suggests the underlying business momentum is there, and maybe Q1 was strong enough to offset that Q2 dip.
It certainly points that way. It argues against a purely structural decline. You know,
But should we be a little cautious? I mean, could that H1 growth just be farmers buying early in Q1, pulling demand forward? How much is real resilience?
fair point. The company would argue, and the data kind of supports it, that the resilience comes from their diversified portfolio.
Ah, the product mix.
Yeah, look at H1 revenue breakdown. Insecticides are the biggest chunk at 39%, but herbicides are strong at 26%, PGRs, plant growth regulators at 11%, fungicides 8%. It's balanced.
Meaning a problem in one specific crop or pest cycle doesn't completely derail them.
Exactly. It cushions the blows. And they're seeing traction with specific newer products, too.
Like what?
They highlighted Lentigo, a new rice herbicide gaining ground, and Excalia Max, a fungicide, apparently maintaining strong market acceptance. These are those higher margin specialty products they want to grow.
Right. And speaking of the portfolio, there was a small note about discontinuing some animal nutrition products. What was that about?
Yeah, the Andy distribution products, they were sourced from the parent company, SEC Japan.
Was it a performance issue?
Doesn't sound like it. The presentation says it was due to a change in the parent company's global strategy, and crucially, they mentioned it was a low-margin trading activity.
So, not expected to really impact the bottom line much, more like strategic tidying up.
Pretty much,
Eh.
focusing on core, higher-margin stuff.
Okay. We should probably also touch on glyphosate. That's been under a regulatory cloud in India for a while.
Absolutely. That 2022 notification restricting its use only through pest control operators caused a stir.
But what's the current status?
Well, implementation is still paused. It's held up pending court cases, specifically petitions before the Delhi High Court. So the regulatory uncertainty lingers, but that immediate restriction isn't actually in effect right now.
Got it. So, looking ahead from H1, what's the company's outlook?
They seem quite positive, actually. They point to healthy reservoir levels across key farming regions.
Ah, good water levels for the upcoming Rabi season.
Exactly. They see that as a favorable base, suggesting they expect a solid recovery in performance in the second half, H2 FY26.
Okay, so if they expect recovery, how are they planning to drive it? Let's get into the strategic pillars, this SCI 2.0.
Right, and you have to appreciate the scale first. This isn't a small operation.
No kidding. 14x growth since FY11, 5 manufacturing sites, 200 plus brands.
And a massive distribution network. 15,000 direct distributors, maybe 40,000 dealers, covering 26 states. It's huge.
So how do you manage that effectively?
A big part of their strategy seems to be deepening the connection directly with farmers. They have this campaign, Every Day, Farmers Day, EDFD.
Sounds catchy. What does it involve?
It's a structured demand generation effort, lots of on-ground engagement, trying to build market pull rather than just pushing products through channels.
And are they measuring the impact?
They are. They highlighted a specific mega week in July 2025, said they saw a 35% jump in farmer plus channel partner connections compared to the year before.
35% increase, reaching how many people?
Over 61,000 total connects in that 1 week.
Yeah.
So it suggests their field teams are really active making those contacts.
Okay, that's the physical side. But they talk a lot about phygital.
Yes, that's the really transformative part, potentially. Marrying that physical presence with digital reach.
And the potential audience is massive, right? Rural India has hundreds of millions of internet users, smartphone owners now.
Absolutely. Over 442 million rural internet users. 425 million smartphone owners. You can't ignore that.
So how is SCIL tapping into that?
They're going big on digital. The numbers are pretty staggering. Over 800 localized landing pages.
Localized meaning different languages, regions.
Exactly. Tailored content. Plus, over 600 precision-targeted digital campaigns mapped to specific local crop cycles.
Wow. And the reach.
They claim 14.2 crore digital touchpoints in total. That's 142 million interactions.
14.2 crore. That's just a massive number. It implies constant, highly segmented digital presence.
Yeah, across YouTube, social media, probably specific farming apps. Being there digitally where the farmer is. And crucially, it's not just about volume.
It's about efficiency, too.
Right. They reported a 17.2% reduction in their engagement costs. Because the digital campaigns are so targeted, they're spending less per meaningful interaction.
Smart segmentation paying off.
And they've even made their physical events phygital. Their traditional field days, product demos in the field, now have this digital layer.
How does that work?
Think live Q&A sessions streamed during the field day, connecting farmers with agronomists, R&D experts online in real time. Adds another dimension to the physical demo.
Interesting. Blending the real world and the digital.
Okay, let's pivot back to the foundation supporting all this stuff, financial health.
And here the picture is genuinely strong. Very robust.
How so?
Well, first off, NIL borrowings. They have a completely debt-free balance sheet.
Debt-free. That gives them huge flexibility, especially in a cyclical business.
Massive flexibility. And on top of that, they're sitting on a mountain of cash. Cash, equivalents, liquid investments. Over Rs 2,089 crores as of September 30th.
Wow, over 2,000 crores in liquid assets.
Yeah. Huge buffer, huge potential for investment without needing external finance.
And this strong position seems to translate into operational efficiency too, particularly working capital.
Yes, this was arguably the most impressive metric in the results, outside the H1 growth, net working capital days.
How much did they improve?
They cut it by 34 days compared to March 2025. Dropped from 89 days down to just 55 days. 34 days? That's a significant improvement in how quickly they're converting operations into cash. What drove that?
Primarily better receivable management, according to the
Okay.
presentation. Just shows really tight financial control, even during that tough Q2.
Okay, so debt-free, cash-rich, operationally tight. What's the next move? Strategic investments, presumably. CapEx.
Exactly. And they announced two key board-approved projects, both focused on expanding manufacturing, particularly for higher-margin specialty products, leveraging the parent company pipeline.
Okay, what's the first one?
Manufacturing a newly launched innovative molecule from SCC Japan at their Tarapur site. Smallish investment, about 10 crore rupees, targeting completion by Q4 FY27. Seems focused on the domestic Indian market for specialty stuff.
And the second project. That one sounded bigger, more global.
It is. Board approval for a second brownfield plant, this one at the Bhavnagar site. This plant is specifically for an important SCC innovated product intended for global requirements.
Ah, so using India as a manufacturing hub for the parent company's global needs.
Precisely. Bigger investment here, around 55 crore rupees, also targeting Q4 FY27. It really shows SCC Japan's confidence in SEIL's ability to produce competitively for the world market.
Yeah, that access to the parent's R&D and global supply chain is clearly a huge advantage. Plus their own R&D labs in India.
3 DSIR-approved labs, yeah. And we should probably give a quick mention to their sustainability efforts, too.
Right, the green energy part.
Yeah, they state that 65% of their total power needs are now met through their own wind and solar power plants. Good for ESG, potentially good for hedging energy costs long term.
Okay, so let's try and pull this all together. We started asking if the year of resurgence tag was just spin, especially after that weak Q2.
And I think the evidence suggests it's more than spin. Yes, Q2 is hit by the monsoon, an external factor, but the strong H1 growth, that incredible improvement at working capital,
Right.
it points to real underlying strength, diversified portfolio, disciplined management.
And they're not standing still. They're strategically investing in those specialty products, pushing hard on this digital engagement to drive demand efficiently.
It feels like a concerted effort to use strong internal controls and smarter market engagement to kind of insulate themselves a bit from the sector's inherent volatility.
Which leads us perfectly to our final thought for you, the listener. SEAL did something remarkable. They improved collections and cut inventory days during a monsoon-disrupted quarter. That's tough to do.
Very tough.
So, given their big bets on digital outreach, on new specialty manufacturing for both India and global markets, how effectively can SEI 2.0 really allow them to decouple, truly separate their long-term performance from the unpredictable cycle of India's monsoons?
That's the multi-billion rupee question, isn't it? We'll be watching closely heading into H2 and beyond.
Indeed. Lots to think about there. Until the next deep dive, keep digging.